Stocks keep marching higher and pulling away from the 30-day moving average to a pretty high degree. So we're going to break down just how bullish we are in the short term, the impact that has on reward to risk ratios, and what that means from a long-term trading perspective, from a short-term trading perspective. And what's really been leading us, especially over the last few weeks, has been kind of a little bit of a regime change in terms of leadership. And what does that mean in terms of the persistence of a really strongly overbought market in the short term, with lacking the leadership that got us to this point, especially in the last couple of weeks. We're going to break that down from a technical perspective. Our trade idea that we're going to look at here today takes a look at one of the stocks in that new regime, that's our new leadership, and that itself is providing a pretty decent higher probability directional opportunity in the next little bit. So we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, June the 8th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 here. You can see another update today. In fact, it's 1, 2, 3, 4, 5, 6 out of 7 days now we've gone to the upside. Basically from the 23% level all the way up. And if you count, go a little bit further, so that's 6, 7, 8, 9 out of 11 days. And then you add these, let's see, it'd be 1, 2, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 out of 17 days. So 13 out of 17 days, we've essentially gone from the 30-day moving average to a pretty high level up above it. In fact, I tweeted this out here. I tweeted this out earlier today that the S&P 500 now is 7.5% above the 30-day moving average. We've seen a move like that. Now, keep in mind, this is not a logarithmic chart, so I apologize for that. Usually I do show log charts so you don't get too crazy on what it looks like. So it's not, it says according to the PPO, percent price oscillator, it is as high above the 30-day moving average as it was back there. So it looks a lot more parabolic now because the numbers are bigger. But the reality is we're as bullish now as we were then. You can see what happened afterwards when we got this bullish away from the 30-day moving average. The NASDAQ is 10% off of its 30-day moving average. It was that bullish earlier this year, and is that way again. It was also close to being this bullish back in 1998, and you can or 2018, sorry, and you can see what happened there. And then finally, the Russell 2000 did not get this bullish. It's 8.5%. Did not get this bullish earlier this year. Did not get this bullish at all in 2018 because remember, it's been in the more of a underperforming bear market. So the last time it was this bullish was actually after the election. Election night 2016. From there, we took off like a rocket, small caps in particular. And since then, you can see what happened when it got this bullish. What happened for the next about 8 months. We had up and down moves, but pretty sideways for most of that time. So we've been this bullish before, as bullish as we are now, but still, that's a lot of days in a row with very, very minimal downside days. Only four down days pretty much in the past 4 weeks. So, and you can also see, too, now that the gap between where we're currently at, today's high point, which we closed just about on today's high, and the 23% level. Remember, any move within this range was just considered noise. This would not be a pullback if we dropped to 29.87. It would just be noise. The pullback starts after you drop below 29.87. And then your support levels would be here, and then another one here, and a minor one here at the 50% mark. But the bigger ones at the 38 and the 62% level. You break through that, and now you start to, now you've kind of lost your bullish trend, and you're going to look for a bearish reversal if you break that, and that's highly unlikely, right? So, but it is very likely to move down to the 23%. It doesn't take anything, right? That's just noise that can move up and down in this area. And so that's more than a 7.5% drop because there's your 30-day moving average that we are up above right now. So it kind of gives you an idea of just how far away we are from how far away the S&P is, how much we've really moved and how really parabolic we've been getting. In fact, the posture here at almost 98, we didn't hit 98 at all here. We hit 95. We did hit 98 right here, higher level, this level, and then this one here where we got a cluster. We also hit above 90 where we're at right now. So just a couple of other times lately. But you can see not very often, right? Here's another one where we got up to 98. We didn't get 98 at all here. We got up to 97.8 at the highest point during this rally. And we're now just pretty much at 97.8 right now. So again, just a reflection of how bullish the near-term line is, strongly bullish. We had crossed, we talked about on Friday, we had crossed above the 78% level on the S&P. The Russell now is up to the 70% level. The Dow has finally broken through it. The NASDAQ obviously has broken through the 100% level. So you can see now, like, this has been a catch-up market. The Russell's been killing everything else since this, during this 17-day rally, that it's only had 4 down days too. The Russell's just absolutely killed it. Well, there's a reason why the Russell's absolutely killed it, because at the time, it was below the 38% Fibonacci retracement, and the S&P 500 was flirting with the 62, was above the 50%, was flirting with the 62% when you draw that Fibonacci line, the comparable Fibonacci line. And at the time too, the NASDAQ composite during that pullback was well above. We had already broken the 78% before that 17-day rally. So again, compared to the Russell was down here, while the NASDAQ was up there. So big gap in performance that the Russell is just now starting to correct, and it's finally up here. You can see it hasn't quite caught up to the NASDAQ because it's broken through its 100% retracement level, but at least it's up to that 78% now, and the Dow is getting through. So the catch-up trade is continuing and getting close to being caught up. Then the question is, then what happens after that? We kind of played catch up over here too, and it didn't turn out so well, and we had a little bit of a bearish intermediate high point here right before things rolled over. So we'll see. We'll see what ends up happening here, but still strongly bullish nonetheless, and the market sentiment line's rising. The Russell's market sentiment line is crossed up above 40 already. It's close to crossing above 50. The Dow's has crossed above 50. The NASDAQ has crossed above 60. It's close to the 70th percentile now. So from a long-term perspective, we're not going to be in a bearish trend anytime soon, according to this chart. Now, mind you, anything can happen and throw your technicals out the window. But according to this chart, we have now reversed enough. Remember, again, this bounce is the result of that drop, how big this bounce has been. If you look, where we're at right now, for example, on the Russell 2000, the last time we moved up to this level was back here in October of 2019. And we went for a few months after that. So it's not like this is a bullish trend, right? Because it's a big bullish bounce off of what was a big bearish move. Now that we break the 78%, now we're back on a new trend, and we can get going again to the upside. If you take a look at how strong this move is from this perspective, you can see the DMI positive very rarely gets above 40, and you can see it's done it here now with the negative well below 20, and the ADX finally, so when we talk about like this isn't a trend yet because of how bearish this was, that's reflected in the ADX. The ADX got strongly big time move up to 50, and then it since has dropped, and now it's just barely crossed up above 20. It took a long time to get up and get going again, and you can see it kind of took a long time to get started over here before this bullish trend finally got going with this bearish ADX. So that's how strong the counter move has been. And then of course, when you look at it from a trend strength standpoint on this weekly chart, now we're finally to the 2 level and the 65 level on this week's candle, which signifies a moderately strong bullish trend. And that's when you say, okay, we're not going to be bearish anymore. Now we are starting this bullish move on a long-term basis. Now it's not just an up and down move. It's a continuation of this trend, right, that we've had going all the way over here. You know, we kind of went parabolic there a little bit. We went down, and now we're right back here. So you can kind of see if I draw my line, if I just kind of move off, if I just draw a line like this, coming from here and going through this trend as best as possible, you can kind of see here that we're back on the trend, right? We went up, way up above it, we went way down below it, and now we're basically back up to it. And that's what this trend strength indicator is telling us. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here, hit the red subscribe button that pops out. Also, there's a subscribe button down below if you're watching us on YouTube. That notifies you when our videos are posted here on our channel. Also, while you're down there, hit the thumbs up icon. That tells me two things. Number one, you liked your video, and number two, you want us to do another video tomorrow. It's a quick way to give us feedback. It helps us see how much you like these videos, you want us to keep doing them. You can click on that right now if you like them. If you don't like it, you don't have to click on anything. And also, too, while you're down there, what questions or comments you have for me about anything we discussed in the video today or anything related to the topics. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to a website where you can subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out our other things on this page too, including our Market Outlook live trade review videos where every day I do the Market Outlook. I also do a live video at 3:30 Eastern here. Click on this to take you there. Click on this image here. You can also get to it here with this link in the Market Outlook menu at the top of the screen. We review all old trade ideas. We continue to manage them like we would any position in our class portfolio. So if you're looking to see how we're continuing to manage some of these old trades, as well as we put on today's trade before the market closes. So if you want to see what that is, then you get access to this with our monthly subscription. You also get access to all 8 of our trading rooms. You can see a few of our upcoming trading rooms here on the right. So again, for more information on those different plans, here's our monthly plan. This is our premium plan. Our premium plan gets access to all that too, in addition to our class forums and all of our custom content and tools that we have associated with and access to our community. So we also invite you to engage with us on social media. Hit this heart that opens up this new window. Click that like button. Hit that thumbs up. Takes you to your Facebook page. Like today's Facebook Market Outlook Facebook post. Again, that benefits us because the more likes these posts have, the more Twitter and Facebook will promote our content to all of our followers. It also benefits you because Twitter and Facebook will promote content in your timeline from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, now let's take a look at the back to the charts here, the weekly chart, and you can see we got the golden cross finally in the S&P 500. Finally, and now keep in mind the NASDAQ has already had the golden cross for a long time. In fact, it only had 1 week of not having one. And the Russell, you can see, is still not quite there yet. It's still going to take about another couple of weeks. And if you take a look at the Dow Jones Industrial Average, it's probably another week away, and you can see where it's at. So we're getting closer on most of these. And you can see this week's candle on a Heikin-Ashi basis, again, very, very strong. The high last week, 32.11, and the close right now, 32.15. So, you know, again, 1 day only, but we're already above last week's candle, and it's a higher close, it's no lower shadow, it's a higher high. And with the golden cross now. Now, remember, a lot of times when you get golden crosses, you retest, and we'll see if that ends up happening. If, you know, again, we can come to the 23% level and retest the 200-day moving average and not be a pullback, right? It would not be a pullback, as crazy as that sounds, because of how big this rally has been, and and how sudden it's been, how short it's been. That would not be a pullback. Getting below it would be, and obviously by then we'd be breaking the 200-day moving average if that happened. But it's a strong break so far, and you can see the regular candle. Very, very strong break. We are well above the 200-day moving average. We are most likely, even when we were in 2016 here, where we kind of failed, we were above the, we were kind of the same thing. We got pretty strongly above, and then in 1 week we came down. You notice that was Also, if you look at it from a Fibonacci standpoint here, and this only lasted about 1, 2, 3, 4, 5, 6 weeks. We did come in 1 week down to the 38% Fibonacci retracement and held that for support and kind of banded, and we actually broke below the 68 and went all the way down again with another death cross. It was very kind of a scary period in terms of being into a bear market there, a real bear market. But most likely we're not going to break back down below the 38% Fibonacci. I think if we ever do, when we ever do pull back, because we will at some point in time. Markets don't go up forever. In fact, the more that they do go up like this, the more it seems like they go up forever. Then again, that's what we saw in 2008. That's what we saw here. That was 2 weeks. 2 weeks wiped out. And as strong of a market as that was, we got to the 200-day moving average in 2 weeks, and we were well up above. Like my tweet, we were well up above the 30-day, like way above 30-day moving average in January of 2018. So we'll kind of keep our eyes on that. If you look at the 3 green arrow chart for the S&P, again, easily 3 green arrows. The volume came way back from Friday's volume. And you can see we're easily above the 8-day moving average as well. I showed you how far above the 30-day we were with on the PPO, very, very high level up above the 30-day moving average. So, it doesn't necessarily mean we have to go down. It just means that there's that downside is risk that we have to account for any reward that we expect from today going forward to the upside. And that's the thing. Someone mentioned on Twitter, who would short this right now? And no one would, right? As overbought as it is, no one would short this. But the reality is, what kind of bullish trade would we make on this from today going forward? On any existing trades, how do we manage them? I've already, in some of our class portfolios, been lowering my deltas on the bullish trades that we've had. They have been doing really well going up into this high because of the potential for weakness that they are already showing, especially on the NASDAQ. If you look at the QQQ, it's been slowing down. It's the Russell. The Russell's the one that's been doing really well, and I believe the Russell's like 8.5% up off of its moving average. So significant move itself. I can't remember the exact number. What was it? It was, let's see, I believe it was this chart, yeah. So 8.5% up above its 30-day moving average. All right, so now when you see also that all these other oscillators like the RSI is, strongly bullish for the S&P, we're above 100 on the CCI, the DMI. This kind of stood out today. The DMI finally turned up above 20, so that's a little bit of a difference versus some of the other strong moves, where the positive directional index got above 40, and the negative directional index is working its way below 20. The ADX was above 20 that whole time here. For example, in this case, in fact, we haven't had a period of it not being below 20 this long since over here when it finally got above 20 here and then broke out. So it's breaking above 20. That's a strong move for the S&P. That's a potential for a strong trend. Look, even Qs are barely. The ADX is barely getting up above 20 there, and IWM has already crossed above 20 because of how strong its latest rush has been. You also notice that its positive directional index is above 40 for the first time in a long time. In fact, if you go out to like 5 years, it was this move right here. That was the last time. Now the ADX was a lot higher back then, but it was coming off of that 2019 low, and then you can see what happened afterwards. And again, that was the last time. We had a really strong. Was it that period? No, it was this period. The last time we had a very strong, and that was another period where the positive, and you can see another one here where the positive directional index got up above 40. And you can see it was a strong run that petered out. Strong run that petered out here. So we'll see if this ends up working out or not. The Bollinger Bandwidth also is growing. You can see the S&P has been above the 75% mark for quite a while and pushing the upper band up and breaking through its point of control. You've got the value area right here for the S&P that we're close to breaking through. That would be very bullish. Now, small caps are heading up against their resistance, and their point of control is a lot higher than it was for SPY, which was lower, or for even QQQ, which was way down here. So IWM has got the biggest ceiling that it has to try to break through in order to break out to new highs like the Qs have been doing. And we're right up there now. So now the question is, are we going to be able to push through this? Are we going to kind of run out of gas in this area, considering how strongly bullish we are in the short term? Again, doesn't mean we can't go up. It just means the risks to the downside. Is the reward from today going forward large enough to compensate for the risks to the downside in the short term? Simply just in the short term when you're looking at from an active trading. From a long-term trading standpoint, for example, in our class portfolio, this has been crazy good for us. I'm just talking about in the short term, especially using our active trading because your long term is so strongly bullish because of how big the drop was, how fast it was. It just makes you so long term bullish that especially when you get this bullish in the short term, you have to cover that risk somehow. And you don't want to change your long term portfolio because that's a passive portfolio. So you use your active trading strategies to be able to compensate. You do have some longer term bullish directional trades which have been working very well for us, but we also need to cover any negative deltas just in case. Just in case we get a 23% drop, which is not even a pullback, would still be a 7.5% drop, would be a significant move to the downside and probably pull a lot of those QQQs that have been very elevated back down towards their now new support after having broken out through those new highs. Let's take a look at the intraday chart here, and you can see the gaps are still there, and again, remember, this is where that 23% retracement level is. That's right there where my cursor. In fact, I have to move it actually. Let's activate this and move it up to right where we close. We close right at the high of the day. So you can see now that's where that is. So in fact, we've kind of filled in some of that gap, but now the 23% line is at the midpoint. We can come down, fill in that gap there, come down to the point of control. It would not be a pullback. It would just be noise because it would be in the upper half of this 4-week range. It wouldn't even be breaking into the lower half. And that's a 7.5% drop, or almost getting closer to 8% drop just to get there. So it kind of shows just how strong this bullish move has been. It also shows what the risks are, right? And do I have an 8% move from today going forward, and more than that actually, to be able to compensate? That would give me enough compensation for the risk of a noisy move and what that can do to any new trades that I might put on right now. Let's take a look at the VIX, because today was one of the first days since 1997 that the VIX was up 5%, while the S&P was up 1%. You can see the VIX was up over 5.25%. I talked to you on Friday about getting down below this level and staying, whether or not we stay below that, and how that can be bullish in volatility. Well, volatility ramped up a little bit. It's not a spike in the least bit, but it's a jump up in volatility and shows just how oversold volatility was. And it can still be oversold, right? We can still move towards the 95% mark. There will be some resistance there, and then of course resistance at 100% would probably cause, a move up to the 100% would coincide with a 22% drop. Breaking up above that, now we start looking for the intermediate pullback if we get up to the 105% mark. So we'll kind of keep our eyes on any rise in volatility this week, and what that, how that might impact the move in the markets. The range today that was very, very small. So after such a big range on Friday and a big volume on Friday, back down to really small numbers and bringing these numbers down. And you can see here, the big thing here is that the ATR continues to slowly move towards below that 2% mark. It's an important trend established, right? And among other things, there's the bullish trend is established. I mean, that's the nice thing. It's not just a noisy bounce. Now it's moved beyond that. Now it's just kind of right in here where it's moved beyond that, but we've moved beyond the fact that it's a noisy bounce. Now, we haven't moved out to the point where we're just grinding, right? Where we can get a grinding move like this, because the ATR is still actually pretty high. The VIX is actually still pretty high. The volumes are still actually pretty high relative to these levels. So we still have some room to fall to get to a trend where we just go up with small moves every day, kind of a normal bullish trend. So there's still going to be some volatility and choppiness. Like I said, a 23% drop would be a nearly 8% move to the downside, and that wouldn't be considered a pullback. So there's still going to be choppiness. When we do get a pullback, it's going to be more than 10%. Again, simply because of how big the rally was. It won't be because it's a bear market or a correction, as the media will call it. It will just be, some degree of pullback of this move. And it would be a 38% pullback. There'd be support. It'd be normal. We could bounce off of it, continue higher again. And then as that ATR falls below, the VIX stays below 90%, then we get to the point where we just slowly grind higher. And that's the easy bull markets where you can generate a lot of alpha because it's very predictable, and a lot of stocks kind of make these nice moves, grinding moves to the upside. All right, before we look at some other charts, let's just review our technical outlook. Again, the trend is strongly bullish. It's overbought in the short term, and that reflects the reward to risk ratio that we have. How much risk to the downside do we have for the reward we seek from today going forward to the upside? Now, obviously, going into today, this reward to risk ratio has been askew for quite some time. So that's why it's been, that's why from a short-term perspective, it's been more of a neutral type of market until this last couple of weeks where we finally started getting some bullish breakout signals, and that this is more than just an oversold technical bounce, that this is a bounce up into a new trend reversal like we see in the Qs, like we saw in the Qs previously, and now we see on these other charts. So now that this new trend, this potential for a longer term trend is developed, and that impacts how we trade things from an active standpoint. Nothing has changed from a long-term standpoint, where when you get big time drops in a short amount of time, they tend to be very bullish over the long term. That so far has played out really well. So again, for the last little bit and continuing into this really strong oversold move in the short term, there's opportunity for us to pull back. There's opportunity for us to keep going up, and the more we keep going up, the more the risk, the bigger the risk to reward ratio is, or smaller the reward to risk ratio is if you look at it from the other direction. And that continues to be the case. And the expectation is, again, especially now that we've crossed and we've got the golden cross, it ramps up the risk of just, like I said, a 23% drop, and nothing even more than that, because that would take you back to the 200-day moving average all by itself. And again, would not be a retracement, would be a noisy drop. It would be enough to have the post golden cross retest. So you would look for something like that to occur relatively sooner rather than later, within, say, the next week or two. All right, so what do you think? Do you agree with that or disagree? Comment down below in the comment section on whether you agree or disagree. And if you disagree, let me know as to why. What are you seeing that either makes you a lot more bullish, that we won't ever get a 23% retracement, or makes you a lot more bearish than I am? What are you seeing that maybe 23% will be nothing, that we've got a lot more retracement to come, based on whatever economic or technical indicators that you're looking at? Share that with our community down below. All right, now let's take a look at what's driving today's action. You can see a big move again in small cap stocks, really catching up. In fact, if I were to change this all the way to the low point, so the March 23rd low point, so we're going to put it on the 24th so we can get that opening gap to the upside that we had on the 24th. So there's that move there. You can see now from that low point over the last couple of weeks, small caps have more than taken over for large caps move. Large caps initially had a good run, a little bit of a catch up on small, then large caps outperformed, and then small caps started to catch up from that low point. You can see international stocks are still lagging behind U.S. stocks pretty considerably. You can see QQQ, which had been such a big winner, is also really lagging behind IWM. In fact, if I were to go kind of year to date, in fact, more towards like this October low point for the QQQ was October the 8th, it looks like. From that October 8th low point here, you can see Qs really took off in terms of outperformance. And then you can see continued to have a really strong outperformance versus IWM, and then still is up 28% from that October 8th low point, and IWM is only up 2% or less than 3%. So it's still got some, as bullish as it's been, it's still got some catching up to do. You also notice too that you have gold and long-term bonds, which were lagging initially. They were so bullish during the pullback. Now they're still holding their gains, and S&P is just barely crossing TLT from, again, that October low point. So we're in the S&P is 10% off that low point, but it's just barely. It's now starting to outperform, and some of these other, especially the international stocks, still haven't yet. They're just barely crossing zero. And of course, if I were to go all the way back to August 20 or January 26th of 2018, remember, all the way up until now, again, you can see how bullish the dollar has been this entire time. That's this line right here. It's just starting to pull back. The S&P now is up 14% above that January 26th peak that we had. Qs are up 43% off that January 26th peak. International stocks still down 10-13%. Even small cap stocks are down from that peak. Small cap stocks actually peaked over here, would be on August the 31st of 2018. So if I were to go from that point, kind of a secondary high here in this bear market for risk appetite, you can see they really fell down pretty hard during Q4. And you can see a little bit of a bounce in commodities. Eventually they peaked in October, and the stock market peaked here in October. But from that point, look at from that August 31st low point, or excuse me, high point, you can see, look how strong gold has been and bonds have been. And Qs are just now, the Qs have been pretty strong in their own right, and small cap stocks are actually still down 11%, while large cap stocks are up 11%. So, as great as small caps have been doing, and as great as international stocks have been doing here lately, and value stocks have been doing here lately, especially the last few weeks, there's a reason. They're still playing strong catch up, and the dollar, which has been so bullish, and these other safe havens that have been also so extremely bullish, still have a long ways to go to the downside. You can see gold is just now showing a bearish posture on this market forecast on the daily chart. Long-term bonds is different than how it has been, and if you take a look at it on a weekly chart, it's still not even close to showing a red line on a weekly basis. Gold is even further away. It's so far up here to the upside. It's nowhere even close. And again, that August 31st is going to be in this area here where we just where things kind of really, where risk aversion really took off, and the only thing that kind of masked it from a U.S. perspective is how strong the Qs were, especially those really high market cap weighted, which lifted and kept the S&P 500 up higher. One big move that we've been seeing here a little bit lately, and I kind of just barely showed it there, is in the 10-year yield. If you look at the 10-year yield, it's really making a move higher now to 90 basis points. So it's really crossed up above the 50-day moving average. Last week, big time breakout to get above the 50-day moving average, holding up so far here this week. And you remember, that's the point of the Hakinyashi, because the Hakinyashi, you can see how strong, how much of a bullish candle that is compared to the little candle we're getting on the regular candles. And you expect to get more of these. And we're not getting a higher high yet, but to get back up to 1%, that's a reflection of rising inflationary expectations. And of course, that puts a damper on the dollar, which is breaking down and moving lower and about to get its own death cross. And we've seen in the past, when it gets a death cross, that can be pretty bearish for the dollar. If you look at its market forecast on a weekly chart for the ETF that tracks the dollar, we are getting dark pink shading and a red line, and oversold short-term sentiment, extremely oversold short-term sentiment, with the intermediate line falling and the intermediate line never getting a good strong bullish high point here. So pretty bearish, and the more bearish the dollar is, the more the positive that is for risk appetite in general. Remember, this is the dollar index, the futures index, which is mostly the euro US dollar. This is the trade weighted US dollar, which is mostly the Canadian dollar, and it's not quite as bearish yet in this market forecast, but you can see how things are turning around for it, and intermediate lines falling and about to cross below its market sentiment. Short-term sentiment is bearish on this chart. That's on the weekly chart. The daily chart, you can see we're getting dark pink shading and a red line there. The short-term lines, but since we don't have an intraday range, kind of makes it a little difficult, but you can kind of get an idea with the intermediate line, especially on a weekly chart. You can get an idea of just how bearish the dollar has been getting, even on a trade-weighted basis. Finally, take a quick look at crude oil, and you can see on a weekly chart how we've made us run up to that 30-week moving average. If you look at it on a Bollinger Band basis here, it's still got some room to run before it gets up to its resistance level. Not very much volume ahead as we're filling in this gap here. Not very much volume ahead of us, so it can make a really decent run up towards $55, $56 a barrel again, with very little resistance and a little bit of support on the downside if we were to pull back and make any kind of retracement move. Let's take a quick look at how the sectors did here today. And we'll just go to a daily chart here just for today, so June the 8th. Go to a 10-minute chart. Energy stocks continue to be the leader. In fact, if you kind of go back just over the last 2 weeks here, so this would be the June 2nd, would be 1 week, and then so there's 2 weeks there. Energy has been a really strong performer. In fact, so has financials and industrials. These are the most beaten up areas during the decline. And now they're really bouncing up pretty hard. And you have technology and communication services lagging behind with healthcare. Those have been previous winners, and staples to a degree. They're all lagging now. And interestingly enough, with rates rising, you have an increase in real estate and utilities, which isn't the norm. Usually they do better when rates are falling. But they've been rising with rates rising, so it's kind of an interesting phenomenon. It makes you wonder, again, if this is our bullishness, 9% in 2 weeks, and this is what's driving us higher, it makes us wonder how strong that is, how likely this is, that what the leadership that we had even before all this coronavirus mess is really lagging. What does that say about this last couple of weeks? If you take a look at this run, since that 514 low point, ever since then, again, energy, industrials, financials, up to 30% off of those lows, starting off a little bit of a drop here initially, but by the end of that 14th, we were up. And you can see technology only up 11% in a market that's up almost 15%, and healthcare up only 5.5%, and was a previously big winner. And you can see what's lagging and what's leading, and it's like, do we think that those are strong leaders that can lead us for the next year, or lead us without a pullback or without any kind of a corrective type move? Considering that they were the biggest losers, now they're just simply bouncing up more than their peers because they had the biggest gap to fill in terms of relative performance to their peers. So for our trade idea today, I want to take a look at Harley-Davidson, which has got a really strong pattern here. Strongly bullish pattern, had pulled back and since has bounced back up and kind of broken through to new highs, short-term highs. Its intermediate line still hasn't gotten into the reversal zone where it can stay for quite a while. If you look at it on a weekly basis, you can see, we're just getting some good, strong short-term sentiment that things are kind of turning around here. Let's take a look at its long-term chart, and you can see we're close to breaking up above the 200-day moving average. The 50-day is rising pretty sharply, very similar to what we see on the broad market as a whole. We're above all the moving averages here, 8, 17, and 30-day moving averages. MACD is rising. Its average is rising. The smooth average. You look at some of these other indicators, like some of the other oscillators, RSI and CCI, for example. You can see we're above 60, above 100. We did get up to 200 over here earlier. So we're in bullish territory for those. You look at the DMI, it's also in its own bullish territory, above 30, now finally getting below 20 on the negative index. Strong bullish trend there, not too overly strong. You take a look at the trend strength indicators. We're through the cloud. We're close to, we've got a moderately strong trend in both of these. They're moving higher. The red line here is much higher than where we are. That's very strongly bullish. It means we've had a good 26-day run, and this obviously continuing to trend higher. You look at its Bollinger Bands, you can see there's a lot of room that it can go, because again, we're kind of into a gap in volume, and so until we get up to this 35 level, there's a good run for this to make. So in terms of trading, we look to buy an out of the money call option, a $29 call. We can sell to cover the $1.57. We can sell the 32 call to help cover some of that cost. And then with the 6 contracts, that leaves me with about half of what I normally do for a normal position, because this is a directional trade. But you can see it's a relatively high probability trade because of the reward potential. It's still a pretty decent reward, especially when you can consider we want to get out, with about half of this loss. So there's still decent reward here if we do make a run to the upside, but not as high as we've seen. So which means it's got a higher probability of working out. So only got to get up to 32, and you can see 32 is like right here. So if we get up to 32, it's making a run through an area where there's very, very little resistance to hold it back. Alright, so that does it for tonight. You've heard from me now. Now I want to hear from you. Use that link up there in the top right corner of your screen to go to our forums, open up any new threads with any questions or comments you have, reply to anybody else's, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video below, follow me on Twitter for more content between the videos, and join our website and our community at marketscholars.com, as well as our Facebook group that we've created. Have a great rest of your Monday night, everybody, and we'll see you all next time.